All right, today we're doing a quantitative deep dive into one of the biggest questions in investing. What really happens to a company's stock when a truly legendary leader finally steps down? And I'm not talking about the emotional end-of-an-era magazine covers. We're talking about the cold, hard data behind the volatility that almost always follows these massive exits.
$4 trillion. I mean, just let that number sink in for a second. That is the almost unbelievable amount of market value that's on the line with the leadership changes that we know are coming in 2026. And this isn't some hypothetical back-of-the-napkin number. It's the real, tangible value tied to just two companies.
So what's the big deal? Well, in 2026, the market's facing something it's never really seen before: the synchronized departures of Tim Cook from Apple and Warren Buffett from Berkshire Hathaway. This creates what analysts are calling a data gap. Suddenly, $4 trillion of value goes from the hands of iconic, proven leaders into the hands of new successors. And in the eyes of the market's pricing models, that value becomes effectively ownerless.
And this all brings us to the one central question for this whole explainer, the question you need to be asking yourself. When the music stops and the dust settles, are investors who own these stocks holding on to a lasting legacy? Or are they unknowingly catching a falling knife, one that's about to see a major correction that history tells us isn't just possible, but actually probable?
Okay, so here's our game plan. We'll start with the sheer scale of this handover. Then we're going to get into the numbers, pricing what's called the succession premium. We'll look at the critical 90-day window that the pros watch, decode exactly how they quantify key man risk, and then explore the massive difference between how retail and institutional investors trade this. And finally, we'll wrap it all up into a clear arbitrage strategy.
You know, when you hear about Cook and Buffett leaving, the mainstream story is all about nostalgia, right? The end of an era. And look, it's true, their legacies are absolutely immense. But for what we're doing here, we need to push past the story and get straight to the data that this story has created.
I mean, just try to wrap your head around these numbers. Tim Cook took Apple from a $350 billion company and turned it into a nearly $4 trillion behemoth, driven by services and an ecosystem nobody can touch. And then you've got Warren Buffett, who over 6 decades delivered a 5 million% return. He built a fortress of value. This is the scale of what's being handed over. And by extension, this is the amount of value that is now at risk.
Okay, so those are the incredible stories. But Wall Street doesn't trade on stories, right? It trades on numbers. So let's translate this narrative into the cold, hard math that actually drives institutional investment decisions. This is where we start to actually put a price tag on leadership itself.
We've got two key concepts here. First is leadership alpha. Think of this as the magic, that unquantifiable it factor a legendary CEO brings. It's the market's belief in their genius. Then there's the succession premium. This is how that belief turns into actual dollars. It's the extra money, the higher valuation multiple that investors are willing to pay just for the security of knowing that leader is at the helm. And when they leave, that premium is what's immediately on the chopping block.
Now this is where it gets really interesting. This isn't guesswork. This is historical data. In the first 90 days after a big CEO exit, these stocks typically underperform the S&P 500 by about 1.2%. But watch what happens over time. At the 12-month mark, that underperformance gets worse, widening to over 4%. And by 18 months, the average correction is a painful 15%, with a 70% chance of it happening. The risk actually gets bigger, not smaller, as time goes on.
And this chart just slams that point home. While the rest of the market, the S&P 500, is just chugging along, making money, the average stock that's just lost its iconic CEO is actively losing value, posting a negative 4.2% return in that first year. They don't just stop winning, they actually start losing.
So that brings us to the professional playbook. See, while a lot of investors are reacting to the initial headlines, the big money is playing a totally different game. They operate on a completely different timeline, and it all revolves around this critical 90-day window.
Here's the key. The big institutions, they don't usually panic sell on day one. No. Instead, they just stop. They shift from being active buyers to passive observers. They take on a wait-and-see posture. And the subtle but massive effect of this is that the stock's liquidity floor, that huge wall of institutional money that's always there to support the price, it just quietly vanishes. This creates a hidden fragility that most retail investors never even see coming.
So how do these pros turn that vague feeling of uncertainty into a hard number they can actually plug into their models? This is where we get into the really cool stuff, the technical deep dive of how you actually quantify key man risk.
It all starts with a foundational tool every Wall Street analyst uses, called a discounted cash flow, or DCF model. At its core, the idea is really simple. A business is only worth the cash it's going to produce in the future. And because a dollar you get 10 years from now is worth less than a dollar in your pocket today, you have to discount all that future cash to figure out what the business is worth right now.
So the pros adjust this model for key man risk in 3 clear steps. First, they do a normal DCF to get a base value. Second, and this is the secret sauce, they calculate something called a founder risk index. This is where they literally score the new CEO to quantify the execution gap between them and the legend they're replacing. And finally, they just apply that percentage as a direct discount to the base valuation, giving them a new risk-adjusted price target.
And this is a simplified version of a formula they might use. Now, don't worry, you don't need to be a math genius here. The key is what it does. That SVQO is a score analysts create based on the new leader's perceived vision, quality, and operations. So let's say a new CEO gets a score of 65 out of 100 because they don't have the global experience of their predecessor. This formula spits out a 14% valuation discount. Just like that, a subjective opinion, the new guy isn't as good, becomes a hard number. An analyst can now say, my real price target is 14% lower.
This mathematical approach leads us to the heart of the conflict, the really brutal truth of this whole trade. It's the predictable and often painful clash between retail investors who follow the story and institutional algorithms that only follow the numbers.
So you've got this huge divide. The retail investor sees a little dip and thinks, awesome, I love Apple, time to buy more. They're driven by brand loyalty, by belief in the story. But meanwhile, the institutional algorithm, it's not thinking. It doesn't have loyalty. It's just waiting for one specific data point, one specific trigger. And that trigger is often the new CEO's very first earnings call.
And this is that trigger. Think about it. If you're a new CEO, what's the first thing you're going to do? You're going to set a low bar, one you can easily beat later. You issue conservative guidance. To a retail investor, that might sound smart and prudent, but to an algorithm, it's a massive red flag. It's a sell signal. And that's when the automated, large-scale selling programs kick in, catching all those dip buyers completely off guard.
This is what institutions are terrified of, what they call the Ballmer scenario. When Steve Ballmer took over from Bill Gates at Microsoft, the company didn't collapse. In fact, revenue roughly tripled while he was CEO. But the stock price? It went absolutely nowhere for more than a decade. Why? Because the market changed the multiple. It stopped paying a genius visionary premium and started applying a boring manager discount. And this happens all the time. Look at GE after Jack Welch. The ultimate risk is that a company can keep growing, but its stock price can be dead money for years.
Okay, let's put all these pieces together. We've talked about the problem, the data, the institutional playbook. Now let's synthesize all of it into a clear framework you can actually use to analyze and maybe even trade these huge succession events. This is the Succession Arbitrage strategy.
So here are your key takeaways. Number 1, quantify the discount. Don't just accept the current valuation. Mentally apply your own 10 to 20% key man risk discount. 2, monitor that 90-day window. Look for signs of quiet institutional selling even if the price looks fine. 3, prepare for the guidance reset. Know that a new CEO's first conservative forecast is a major institutional trigger. And finally, number 4, always watch out for Ballmer stagnancy. Remember, the business can grow while the stock goes nowhere.
Which brings us right back to where we started. But now you're armed with a totally new framework. You understand the succession premium, the 90-day window, key man risk, and the institutional playbook. The question is still the same, but your ability to answer it is now fundamentally different. So ask yourself again, are you holding a legacy or are you holding a falling knife?